Limited Q2FY23-24 earnings conference call. We hope you all are keeping safe and healthy. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I will now hand the conference over to Mr. Ashwath Ram, Managing Director, Cummins India Limited. Thank you, and over to you, Mr. Ram.
Thank you. So good morning, ladies and gentlemen. Welcome to the Cummins India Limited Q2FY24 earnings conference call. I am Ashwath Ram, Managing Director of Cummins India Limited. Joining me on the call today is Mr. Ajay Patil, Chief Financial Officer of Cummins India Limited. Thank you all for joining us on this call today. The quarterly results this time demonstrate a stable outlook in the domestic market and a resilient Indian economy, while the key economies and regions of the world are experiencing slowdown in economic growth rates. I would first like to share an update on our Q2FY24 financial results. For the quarter ended September 30th, 2023, with respect to the same quarter last year, sales at rupees 1,871 crore are lower by 3% compared to rupees 1,922 crore recorded in the same quarter last year. Domestic sales at rupees 1,364 crore are lower by 2%. Exports at rupees 507 crore are lower by 4%. Profit before tax at rupees 426 crore is higher by 27% compared to the same quarter last year. For the quarter ended 30th September 2023, with respect to the last quarter, our sales at rupees 1,871 crore are lower by 14% compared to rupees 2,175 crore recorded in the last quarter. Domestic sales at rupees 1,364 crore are lower by 19%. Export at rupees 507 crore is higher by 2%. Profit before tax at rupees 426 crore is higher by 3% compared to the previous quarter. I would now like to share the segment-wise sales breakup for the quarter ended September 30th, 2023. Domestic sales – 28% lower compared to last year and 44% lower compared to last quarter. Distribution business sales were rupees 549 crores, 23% higher compared to last year and 3% higher compared to last quarter. Industrial domestic business sales were 300 crores, 20% higher compared to last year and 27% higher compared to last quarter. Exports, high horsepower exports were rupees 264 crores, 13% higher compared to last year and 8% higher compared to last quarter. Low horsepower exports were 209 crores, 14% lower compared to last year and 4% higher compared to last quarter. I am now providing Cummins India financial guidance. The Indian economy remains resilient to geopolitical events, softening demand in developing economies, and the inflationary trends seen both in India and worldwide. GST collections continue to remain strong, indicating underlying trade activities. The Index of Industrial Production (IIP) PMI, etc., are all indicating a reasonably stable economic outlook, keeping the Indian economy on course for growth in the range of 6.3 to 6.8% based on various estimates. Geopolitical events, especially further escalation of conflict in the Middle East, fluctuation in crude oil prices, rising US bond yields, and their impact on capital flow are a few key watch-outs. The company successfully launched the CPCB4 emission norms compliant products in the market on time. The prior 2 quarters witnessed some demand shifts as both CPCB2 and CPCB4 Plus products are allowed to be sold till June 2024. We expect the demand to normalize and sustain for the rest of the year. With most of the developed markets experiencing slowdown in demand, we are closely monitoring our end market conditions. The company continues to have prudent capital allocation and cost management and has a strong balance sheet and cash position. We remain optimistic about the company's prospects for continued profitable growth. We remain optimistic about the prospects of the company's continued profitable growth and expect double-digit revenue growth for fiscal year 2023-24. I now open the session for questions. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may please press star and 1 on the touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Avendus Spark. Please go ahead.
Hi sir, thanks for taking my question. My first question is with respect to the power gen business. During the quarter, it's obvious that we have seen a revenue decline because the pre-buy activity which was there in the first quarter is getting normalized. My question is more towards the secondary demand. I mean, from the GOEM to the end customer level, how it is. Especially in the HHP level, there is about 750 or 800 kVA. It shouldn't have been impacted by this pre-buy activity, right? So how that demand is, which sectors are driving growth? If you can share your thought process a little bit.
Yeah, so demand continues to remain robust, especially in the domestic market, and we have seen quite a bit of depletion in the inventories that were built up as part of the pre-buy. And we are seeing the demand continue to remain strong. So we are quite hopeful that the remaining quarters we will see a bounce back as far as the numbers are concerned from a domestic market perspective.
If you can give it in terms of numbers, like volume growth in the LHP business, how it was year on year for this quarter, HHP, how it has been. If you can share that perspective, it will be great.
Sure. So for us, we have seen that, just one second here, I'm just pulling up the numbers here. Right. So we saw demand in LHP of drop by nearly 60% versus the last year, and we saw MHP demand drop by nearly 70% as compared to the previous year, whereas HHP demand we saw only drop by 2% because we count HHP at 500 kVA and above. So you can see that there is hardly any drop in HHP. So your hypothesis that should not impact HHP is actually correct. and some parts of HSP continue for us to remain under allocation because we continue to build long-term capacity, which takes 18 to 24 months to build out. Whereas the LHC and MHP markets have corrected from an inventory perspective, and we expect that to come back to a steady state level of what we saw in the first quarter. We expect that to come back to those kinds of levels.
Got it, sir. And my second question is with respect to the industrial business. We have seen very good growth of around 20%. Where has this growth come from? Is it from the construction equipment side, compressor side, railway?
Yeah, quite good bounce back on construction as compared to the last year, primarily driven by the fact that road construction has begun again, and we expect that trend to continue because from the stated ambition of building 12,000 plus kilometers of road this year, only 4,000 has been completed so far. So there is a lot of work yet to be done. So that market historically has underperformed, and that is now starting to bounce back pretty robustly. Also, some of our other businesses in industrial are a little bit lumpy. So, you see some spikes happen and then you see steadiness in some quarters, or you see a dip in some quarters just because they get delivered. And so we saw some very good delivery of rail in this quarter, driven by power car and DETC. We also are starting to see the compressor business start to bounce back. Sometimes we have seen this trend historically that when monsoons are not that great, people have to drill more for water well and other applications, and the compressor market then begins to bounce back. And we also see other markets, especially areas like defense, start to come back, and again, those are lumpy in terms of delivery. So when we have good delivery like we did in the previous quarter, we are able to grow that business. But overall, as long as the core infrastructure continues to keep getting built out, so mining, for example, is much lower in this quarter as compared to the previous year, same quarter. But there are many tenders out there because mining for steel as well as coal is actually beginning to scale up quite significantly. So we are quite optimistic that the demand will continue to improve in that segment as well.
Got it, sir. And my final question is with respect to the gross profit. Gross margins have expanded very significantly. Is it because of the mix being in favor of the higher end gensets being sold and coupled with raw mat going down? So is that the case?
So like in some quarters you get a perfect storm of bad news, this time we have a perfect storm of good news. In that we were able to control the material cost, all the advantages we had of continuing commodity corrections benefited us. We continue to hold on to pricing, and we also got favorable mix because lower margin products in low horsepower, etc., the demand was significantly lower. So all three variables which impact our material margin were favorable, and that's why the material margin improved significantly.
Thanks a lot, sir.
Thank you. The next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi Ashwath. Congratulations on a great quarter, sir. So my first question is on what was the mix of the CPCB 4 in this quarter? Because I think last quarter
I'm sorry to interrupt. Mr. Kandpal, your voice is muffled. I would request you to kindly use your handset, please.
Yeah, using my handset. Hello?
Yes, sir. Please continue.
Yeah, so in the mix, what was the contribution of the CPCB 4 engines? Because last time I think we had said that we will be targeting about 24% for the full year. So any positive surprise we are seeing? I was seeing on your social media handles you've been promoting with your dealers all these CPCB 4 compliant engines. So how's been the feedback from the channel, from the end customers? So any earlier trends of picking up of demand despite the prices being higher and still some time before it gets implemented?
Right. So actually, it's pretty positive news, especially in the areas like the NCR region and the big cities. People are switching over to CPCB 4 Plus despite the pricing advantages of CPCB 2. Just because the product is newer, it has better, longer life, better performance, etc. There are some nodes where we are actually now scaling up capacity to be able to supply CPCB 4 Plus products. But that is only true in the big cities. In all the other regions, CPCB sale continues to be strong, and I can't give you exact numbers, but I would say that greater than 70% of the sales for the quarter were with CPCB 2 products. But the very fact that CPCB 4 Plus, I was expecting 5 to 10%, but the actual demand is a lot higher than what I was anticipating.
Could have that also impacted our gross margins and slight better mix in the CPCB 4 Plus? Because I think
little bit, but not yet significant enough because the ratios are so skewed in favor of CPCB 2 Plus. It's more to do with us not selling as many low horsepower sets as compared to just selling more CPCB 4.
Was there any one-offs in this quarter in the margins and gross margins? I mean, despite if I even take the degrowth in the low horsepower engines, still the margins look better. I mean, the benefits. I mean, we've been holding on to the volumes, not much of a degrowth fee. So, were there any other one-offs, or it's largely just, as you said, commodity benefits and just the pricing being holding on?
No, actually, this is just sometimes you get the positive effect of all the work you've been doing for a long time. So no one-offs, but we are pretty happy that we are happy with good news sometimes. So.
Okay. And this is the last question on the exports market, sir. I mean, how is your strategy on the CPCB 4 Plus? I mean, I've been doing promotions in India, the channel network. So how's been the response, has been the promotions or marketing being done for the CPCB 4 Plus compliant engines in the export markets?
Right. So till the last quarter, we were focused on launching the CPCB 4 products in the domestic market. So all the fine-tuning, testing, validation, approvals, branding, all of the work was 100% focused on the domestic markets. Once the launches were complete and once we got the news that in India we have decided to push out the implementation for another year, we are now focusing all our energies on trying to figure out how to sell these same products into other markets. The first markets where these products can be used well are in the European Union. And so now efforts are on to take the product and get the required approvals in the EU, get them customized for those markets and those applications. And there is a global plan which has been put in place stage by stage on how the product will be transitioned first to EU and then to markets in America where the voltages as well as the frequencies at which those gensets operate are completely different. And so we are going to have to do some modifications on the product to be able to meet those specifications. We expect to get all of this engineering work done in the next couple of quarters. And so to answer your question, work is going on and we are pretty focused on trying to push these products on a global scale because we feel these are world-class products and we have a very good price positioning to be successful globally.
Okay, sir. Thank you and wish you all the best. Those are my questions.
Thank you. The next question is from the line of Ankur from HDFC Life. Please go ahead.
Hi, good morning, sir. Thanks for your time. Just touching back on the domestic power gen segment. So if you could just highlight again, how's the inventory in the channel with your GOEMs, especially post the pre-buy and now, of course, we've seen some normalization in Q2. So do we, and correct me if I'm wrong, but do we expect Q3, Q4 to be more normalized quarters now that most of this pre-buy and the normalization being over. So what kind of growth do you think for the full year is possible?
Yeah, so we think inventories are pretty much back to the normal inventory levels the channel had before the pre-buy, and which is why we think that Q3 and Q4 will be, from a demand perspective, what I consider regular quarters, which means we continue to attempt to deliver the domestic market at 2x of the GDP in terms of growth. So that's where we think we will be able to get to by the end of this year.
Fair. And on a related note, you were talking of some supply chain or potential supply chain issues because you're making both the 2 and the 4 engines. So is that largely sorted?
Some parts of it are sorted, but some parts of supply chain are not fully sorted because they take a couple of years to put the incremental capacity in place. And we are already making all the investments for that. We started making the investments nearly 2 years ago, but it takes time for setting up some of these large engine capacities. And so we are meeting demand, but we are not able to, have excess supply available to meet unconstrained demand. So it is still constrained demand. So we expect I would think by early part, middle of next year, to be in much better position as far as supply is concerned. The other part of supply is the global electronic supply chain is still in crisis. So despite this being a reason I've been stating for almost 3 years now, it is still in allocation. So we are not getting 100% of all the electronics that we need to meet all the demand in the market. So it's still, we are keeping strategic inventory, we're doing all the necessary things, we're negotiating, we're setting up more suppliers, we're doing all the things, but if there is a spike in demand in certain other markets around the world, sometimes we are not getting all the parts that we need. So it is still constrained. So it's not yet a situation where I can say that every piece of demand will be met. It's still wait and watch on some notes.
Sure. And on the export piece, while it's obviously grown Q on Q, we're still seeing a slight decline on a YOY, but surprisingly the SHP growing and the LHP declining. So if you could just help us, and I understand Q3 typically is the weakest quarter as we head into the calendar end, but how do you see the export piece kind of playing out next couple of quarters? Will 23 end be the bottom and maybe start seeing better numbers going into 24? How should we look at it?
Yeah, so this quarter HSP was robust because we were still fixing and delivering on backlogs. And we are seeing pretty much all markets around the world start to slow down a bit. There are some pockets in Africa which continue to do okay. There are some pockets in Latin America which are okay, but when you look at the overall trend, whether it be Europe, whether it be China, whether it be big chunks of the Middle East, we are starting to see demand drop pretty significantly. We are trying to counter that by trying to launch more products and do those kinds of things. But when typically some of these markets go down, they go down. And we've been able to hold out for this quarter, but I am, from the way I see the order board show up, I think it will continue to weaken for the next quarter and maybe start to pick up in the fourth quarter.
Got it. And just the last one is on the defense side, and there's some news flow about Cummins being selected to supply the engines for the light tank project, the project Goravar. So if you could just help us, what is the kind of supplies you're going to do here? Is it from Cummins India, the listed entity, timelines for delivery, etc.?
Yeah, so these are long gestation projects, and here on this project that you're mentioning, our partner is Larsen & Toubro, We similarly work with many of the OEMs in India to supply them engine products, and this order has been one after many years of work, and it's right now in the trial stage, etc. And as the drawouts come from the customers, they will be supplied. This product is made in North America, and some value add is done in India and then supplied to this customer. It's a very specific and special purpose designed defense product. So it's not a mainstream product which has just been adapted. It's a very special product just designed for defense, which has been used by Cummins in markets in North America and other places.
Okay, sir, great. Very helpful.
Yeah, just to provide clarity, that is just for this order. There are many other defense projects which we are working on, which have all localized product as well. I was referring to the very specific order that you mentioned earlier.
Sure. Got it. Okay, thanks.
Thank you. The next question is from the line of Jonas Bhutta from Birla Mutual Fund. Please go ahead.
Thank you for the opportunity and congratulations on a great set of numbers. So two questions. Firstly, given that it's been more than a quarter now that we are selling both CPCB4 and 2 engines, what are the sort of early indications that we are seeing in terms of the absorbable price increase? Because, I remember that you told us prior to the launch that anywhere close to 20% upwards would be the pricing impact. But in reality, what is that on the ground in terms of the price rise that we've been able to pass through without impacting demand?
What the price indications that we have given, those are the exact price indications that we have launched the product within the market. And this is the first quarter where we've started to see demand, and we are in the areas where the demand is the highest, which is the NCR region and in the big cities. We are not seeing that as impacting demand. As a matter of fact, we are getting greater demand despite the pricing, because the product is that much better. So we don't see once the overall transition happens by middle of next year that this incremental price is something the market will struggle with. This kind of transition has happened in multiple markets around the world and in multiple products, where there is psychological resistance to start off with, but when it is the same for every manufacturer and the industry has changed, then everyone just aligns to that and moves ahead. And company has also been looking at alternate means to be able to work with banks and other financing agencies to help people finance these products, etc. So the net impact on individuals is not as significant as one might think.
Got it. So in a full year, so say starting June 24, if volumes remain as is where is in terms of the demand, it's next year potentially then our power gen sales, by the virtue of just the sales mix, should be up at least 15% or just because that's going to be the pricing impact. Is that a fair assessment?
It's a fair assessment, but that doesn't really hold true for all products. There are some products where just because of volume and the change in platform, there's a higher content of imports, and even if prices go up, but margins don't necessarily go up in the same proportion. As a portfolio, we will continue to do better than what we have done. But that does not mean that this translates into like today we are making 20%, next year we'll make 40%. No, the math doesn't work out that way. You continue to keep it, and our ambition is to continue to grow our overall margins by 100 basis points year on year.
So, which was what my follow-up question was, sir. Now, so since we have an indication of the pricing being absorbed, also could you help us understand the gross margin differential between the CPCB2 and 4 Plus now, given that the supply chains are in a way stabilized. So, where are we settling now, and then what is the roadmap?
It's very difficult to give you this at this stage because, first of all, we are just coming out of a quarter where utilization is incredibly low. We are burning off inventory from an older cycle. We have just started to ramp up a new cycle. So it's very, very difficult to give you an answer to say what a stable situation will look like. All I can tell you is that if once we reach steady state and the percentage of CPCB4 becomes greater than that of CPCB2, margins will maintain this positive trend line of improvement.
Got it. So my second question was on, the VRS scheme that we've launched. If you can walk us through the rationale, because, if the going is so good and then, capacities are coming up, what is triggering the VRS?
Sure. So, first of all, you have to keep looking at people cost in India. People cost in India is rising at the rate of roughly anywhere between 10 to 15% on a year-on-year basis. And so, it's almost keeping pace to the rate at which growth in sales is happening. And we continue to look at opportunities to improve cost efficiency, whether it be material cost efficiency or people cost efficiency. Also, given the softening demand and uncertain economic outlook in some of the global markets, we need all of our employees to help reduce costs, lower inventory, and just manage our efficiency as we continue to meet our goals for profitability and cash flow. So this is an ongoing exercise of cost management, of pruning, of cutting, of trying to get more and more efficient as we move along. This is not something which is new that the company has done. There's a lot of focus on cost management throughout the year and over the last couple of years. But we continue to face, growing costs. So we're just looking at ways to keep managing that and getting more efficient.
Sure. And my last question, if I can just squeeze in, so the export sales that and your commentary suggests that developed markets seem to be softening in terms of demand. Could you please remind us in the first half or in FY23, developed markets accounted for what % of exports? And again, is it fair to say that these are markets where our margins are relatively better than that in emerging markets? Because there we have in emerging markets we run our own distribution channel while in the developed markets largely to the parent entities. If you can give us that will be helpful. And that's my final question. Thank you.
Actually, it's pretty complicated because it depends on what products and it's a whole bunch of mix. But all I can tell you is that the developed markets of Europe and North America have dropped over 50%. So as compared to Asia Pacific, Middle East, Latin America, which are dropping more 5 to 10%. So the proportionate drop is significant in the developed markets. But it's difficult to say how that impacts margins because the products and the mixes are completely different for each of those and they keep changing.
Sure. Appreciate it and all the very best. Sir. Thank you.
Thank you. The next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, thanks for the opportunity and congratulations for very strong results. My first question is coming back on the export side. While you did mention of glaring decline in US and EU, is part of the decline also attributable to significant inventory destocking which these markets are witnessing after the pandemic now? Given average inventory in these markets for various products have had shot up very sharply, and customers are pruning inventories to keep the cash profits better. So if you can throw some more color on this?
Yeah, certainly that is a fact. As a matter of fact, when Cummins Incorporated announced their results, they did mention that significant amount of inventory correction has happened and will continue to happen. So that is a factor in it, a big factor, and especially for the next quarter, it will be a big factor because as companies come to the year end, they try to optimize inventory as much as possible. But that doesn't take away from the fact that because of all these Middle East crises, oil prices going up, Ukraine, Russia still not getting resolved, the entire China market still recovering slowly, there is slower demand from pretty much all over the world. So that has also got a part to play. We continue to push aggressively to try to compensate loss in demand from the overall market by attempting to gain share, etc. But the reality is that there is softness in the base demand itself.
Sure. And when we talk about attempts to gain share and presence in export portfolio, typically these would be for which type of applications, which type of generics that we're talking about?
These are what we earlier have said that we had done our fit for market 1, fit for market 2. Now we are in the process of launching fit for market 3. And what we're trying to do is to try to develop products which are very, very suitable to specific regions. Earlier we used to have one product which was the same product for Europe, for Africa, for Middle East, for America, everywhere the product was the same. Then with Fit for Market 2, we did some percentage of delineation of products based on the geographic location. Now Fit for Market 3 does that even more, and it also tries to take some of the products developed for CPCB 4 Plus and applicate them into other markets. So the combination of all of these efforts, more local understanding and then developing products to meet those markets, is what we are working on to improve market share even in a declining market situation.
Got it. Secondly, on the margins, while you did highlight that 2Q was the perfect quarter in terms of mix and various other elements, as we move in the second half of the year, commodities remaining benign and volume growth coming back on the domestic power gen business, can we assume gross margins to sustain that 32-33% levels? And from a longer term perspective, you tend to highlight that company would target 35% kind of gross margin from a longer term perspective. So how should we read into the margin trends expected for second half of the year, and from a medium term perspective, how long it may be for us to reach 35% kind of gross margins?
Yeah, you are referring to material margin at 35%.
Margins, yeah.
Gross margins are a lot lower, but material margin, like I said, it's a perfect storm of everything going well. We expect certain parts of it to act negatively compared to 35%, which is almost like an all-time best kind of number. And we expect with the mix changing in subsequent quarters, with larger low horsepower being sold, more of the data center PDI markets being served, etc., that at least a couple of percentage points will drop from the material margin with that. But our endeavor is to not give up all the gains and somewhere go between 32 to 34% is the number we are continuously striving to hit. And when it goes below that, it makes us grumpy. When it goes above that, we are slightly pleased. But 32 to 34 is the range we are trying to as our sweet spot of where we would like to remain consistently.
Got it. And lastly, any updates that you would like to share in terms of new product introductions or launches across different applications in the industry business?
Yeah, quite a few. They just keep happening. I think the gentleman earlier spoke about some of the defense launches. We've finished introducing all the power gen domestic market. We've introduced RECD kits. We are selling more products into the rail market. We are also launched some special propulsion engines into the marine market. We have launched some new gensets into the marine market. In the mining market, we are trying to win some orders for QFK23 based engines into that market. What else have we launched?
Anything on the Vande Bharat and the electric locos and the trains that we are looking at?
Those are in final stage of approval. So those are what we call hotel load converters, and those are in final stages of approval. So we haven't yet finished that work. That is all incremental. So that is in type testing right now. So once those get approved, we will be talking about different types of numbers as compared to what you are seeing now. We've also been able to launch some of our L series engines for the defense market with customers like Bharat Forge. So yeah, lots of things being launched in parallel. So that's going to be an ongoing effort, and every quarter we will attempt to launch more products.
Thanks much. And lastly, any updates that you can share on the likely capex for fiscal 24 and for 25 for Cummins India?
It's pretty much in line as what we've indicated. No special capex other than for launching products or for upgrades to products, etc. So it's likely to be in line with what we were doing this year, maybe 5-10% more because sustenance increases as the asset base increases.
Thanks much and best wishes, sir.
Thank you.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Good morning, Ashwath. Congratulations for good numbers.
Thank you.
So Ashwath, the question is, when we actually anecdotally see the construction equipment market, we see a significant increase in market share for the Chinese players. And we have a large market share in the construction equipment segment. So if you could just give us an outlook on how are we seeing this market? Are we also able to maintain our share with supplies to these Chinese equipment suppliers?
Yeah, certainly the Chinese are very strong, not only in India but around the world. And Cummins, having a presence in pretty much all markets around the world, also has relationships in terms of supplier, customer with many of these companies. And so when they bring their products to India and then they have to meet local value add and content requirements, they certainly approach us, and they look at us as prime partners to supply them the powertrain. And we are working with pretty much all of those OEMs. But we also continue to work with our traditional OEMs from America, from Japan, from Europe to supply them products. This is a sweet spot for Cummins around the world, and we intend to continue to improve our position in this space.
Sure. And on the competitive landscape in this segment, because Weichai has also set shop here, and similarly on the power gen side, if you could just talk about the competitive landscape, because certain other capital good companies have been complaining about a sudden surge in the Chinese imports, and which is hurting them.
So certainly, those companies are pretty aggressive, and they are state-run companies, and they are able to deploy scale like we cannot. So certainly, we are under competitive threat, and certainly we do pitch to the government in cases where we find unfair prices or dumping of goods at unreasonable prices. We do write to the respective government agencies that we are happy to compete on a fair basis, but when pricing is unfair, it becomes a challenge, and customers are not so discerning in the end markets. For them, price is everything. So yeah, we do lose some kinds of orders, but when it is compared spec to spec on product technology, etc., we have an advantage. when it compares, we also have huge amounts of localization, so we are able to stand toe-to-toe and fight with them even on prices. But when it is unfair pricing, in certain cases we have seen that, then it becomes a challenge. But it's not a significant challenge as of today, but it can be in the future.
Sure. So on the exports, so historically we had a larger share in the African and some of the developing markets. If you could just help us the geographical share and the ongoing currency volatility in some part of Middle East and Eastern Europe, how is it impacting our outlook there?
So Asia Pac, I can give you the breakup of how the 507 crores of exports was region-wise. So Asia Pac was 122 crores, Latin America was 137 crores, Middle East was 111 crores, Europe was 64 crores, Africa was 63 crores, and the US was 8 crores. So we have seen the biggest drop, as I mentioned, 50+% kind of drops in Europe and North America, whereas we have seen smaller drops in Asia and the Middle East as of now, but we expect that to worsen in the next quarter.
Sure. Thank you so much for taking my questions.
Thank you. The next question is from the line of Amit Mahawar from UBS. Please go ahead.
Morning, Ashwath, and congratulations on great operating performance. So my first question is, so in H1 we've done around 30 billion for the domestic sales, up around 19%. How much of that is CPCB4 revenues? I'm sure if I missed that. And is that broadly 100% market share in H1 for you at this stage?
In H1, I would say CPCB sales are less than 20% of our power gen sales.
Okay. So in your assessment, so maybe today we are the only supplier of the new node within the permissible range. Do you think maybe 6 months to 12 months is the time where you will have competition joining in terms of entering the market, or it will take much more longer? I appreciate you can't take names, but qualitatively you can help us understand.
Yeah, I think all competition have announced that they have product ready, because the launch was supposed to happen in July. So they may not have been 100% ready, but I think everyone has announced that they have some product ready. So it's absolutely going to be the scenario that when it launches 100%, that everyone will be ready. But it also means that we've had 1 year to further fine-tune these products and make them even better and even more efficient. So this is an ongoing cycle, and we play this competition throughout the world, and which is why Cummins continues to invest very, very heavily in product technology, so that we can remain ahead of competition.
Great. So then my final question is on FY25. On a normalized basis, what would be the volume growth for the industry for the power gen? Thank you.
We think that the power gen market, at least for the next few years, will grow at a CAGR of at least 7 to 8% in the domestic market. And it has been our stated ambition that Cummins India Limited grows at least 2x of the GDP. So we expect for the next year the GDP to grow at least 6.5%. So which means you got the automatic answer that we will aim to grow at least 13% to meet our own internal aspirations.
That's very helpful, Ashwath. Thank you and good luck.
Thank you.
Thank you. The next question is from the line of Rahul Gajare from Haitong Securities. Please go ahead.
Yeah, hi. Good morning, gentlemen, and thanks for the opportunity. I wanted to continue from an earlier participant question where you talked about, ultimately moving toward a sustainable material margin of about 34 to 35% over a period of 18 to 20 months. I think you talked about this almost a year back. Now, today you are talking about, material margin moving or remaining between 32 to 34%. So is this a clamp down on your earlier thought process of the company being able to move towards 34-35% margin?
No, I think it's not a clamp down. I guess what I meant to say is we have already achieved 35. But that is because we had all good variables work in our favor. That's not going to be the case in every quarter. So what we are attempting to do is, if you look at the previous year's material margins, they were closer to 30.8%. So from that framework, to move the entire average up by 5% could be a multi-year journey. But the 32 to 34% range that I indicated, it seems that it can be sustainable at least for the next couple of years as we build up the next series of cost structure and material structure, products, etc., which then eventually get us to that 35% kind of level. That it would make us extremely happy to be able to get there. I'm just stating that it's easy to put out a number. It's quite complicated to work systematically to be able to get there. So the bridge between 30 to 35 indicates that we need to sustain 32 to 34 at least for a period of time before we can build on it and then get to 35 on a consistent basis. So that's where we think we are going.
Okay, fair enough. So my second question is, we do understand from our channel check that the inquiry level have seen material rise, in the recent months. But I think your commentary seems to be, or it appears to be guarded in terms of domestic growth of, mid-teens, especially when Q3, Q4 are normally stronger for the company. Can you talk about this?
Certainly, a little bit of the domestic growth, we do think it will be in the mid-teens, because if the market itself grows at 7 to 8%, we are growing even faster than the market. So we do think that that itself takes a lot of work. Also, there is a whole bunch of, as I said, inventory is burning out, but it doesn't burn out evenly across all the nodes. So there are certain nodes where there is slightly higher inventory. There are certain nodes where there's lower inventory. So when we try to create a portfolio of all of this, it then causes us to think that there will be a little bit of muted growth as compared to what the real demand in the market is.
Okay. So my final question is, you did talk about various industries, but can you talk about what is the situation as far as demand from data centers is concerned? Thank you very much.
Very strong.
Can you quantify some that demand, please?
So year on year, we have the data center business. Our whole business is growing at 12 to 13%. Data center business is growing at a CAGR of 25% plus.
Sure. Thank you. This is very helpful.
Thank you. The next question is from the line of Puneet Gulati from HSBC. Please go ahead.
Yeah, thank you so much and congrats on your numbers. In the beginning, you also gave a guidance of double-digit revenue growth. Is it possible to break it up between domestic and exports, and also how much of this growth would be attributed to volume versus pricing?
It's difficult for us to give you that exact breakup on where we think growth will come from at this stage. But our ambition has been that, irrespective of which markets go up or down, as a company, we demonstrate that double-digit plus growth. So that has been our endeavor, at least for the last few years, and so far we've been successful at that.
Specifically for FY24, when you guided, possible to break between volume and pricing?
It's always a combination, so it's very difficult to give you an exact answer on that. Certainly volume, as I mentioned earlier, the power gen and some of these markets grow at 7 to 8%. So you have to do the math. So if the market grows at 7 to 8%, we get some market share, and then the rest is all pricing.
Understood. Secondly, if you can give more color around what's driving the distribution part of the business so strongly for you. If you can highlight specific customers.
So we have believed that historically we have underserved our own entitlement of the distribution business. But we certainly saw strong demand coming from parts, quite robust commitment from customers in terms of service contracts, especially from rail and from big customers in mining, etc. And even our rebuild business saw very good demand pickup. So the nature of the business for us has changed quite significantly, and we expect to see this kind of trend continue.
And is there room for further, gain in market share in the distribution business, or have you achieved the optimal level yet?
No, the answer is yes. There's always room for improvement, doing better, and if the overall company has to grow at 2x the GDP, every business needs to continue to grow at disproportionate level to the market.
Understood. And lastly, on the exports, there was a divergent trajectory for LHP and HHP. If you can guide to what drove the difference and.
Yes, so it's very clear that HHP has always been in a backlog situation. So when you're in a backlog situation, even if the inventory corrections happen and demand starts reducing, you're first fulfilling whatever was already in the pipeline. So the drop is not significant in HHP till the previous quarter. Whereas low horsepower, there has never been any supply constraint in those markets. So, as the demand corrects, you see a direct correlation of that stuff. So that's why LHP and HHP are a little bit divergent. And also a big chunk of HHP goes directly into product, into some of our internal applications. So that demand remains a little more steady than the end user market segments, which react more rapidly. So when it goes up faster. When it goes down also, it goes down faster. And this is a typical trend you see different in LHP versus HHP.
Right. And would the similar trend have prevailed in LHP segment as well, right? You alluded to a 60% decline in the domestic market. So that's similar in the sense.
That is correct.
Okay. That's very helpful. Thank you so much and all the best.
Thank you. Ladies and gentlemen, please note we'll be taking only last two questions from the participants. The next question is from the line of Koundinya Nimmagadda from Jefferies. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Most of my questions have been answered, sir. But just one question on the CPCB for engines. So when you try to deal, interact with your channels, what is the kind of feedback that you're getting with respect to competition? I mean, with respect to the pricing, price point at which they are launching their products, and do you see any tilt or sense towards down trading in the industry? Can you provide some color on that, please?
Not seeing the downtrend in the industry, so start with that first. Product is very, very, very well received in the market. Channel is quite excited about the product. As a matter of fact, channel is pushing us to give them even more product. In some nodes, we are lagging in terms of supply because we didn't think the demand would be pulled through as fast as we would have liked. As far as pricing is concerned, the pricing is being absorbed. We're not seeing any resistance to the pricing from the market at this stage. And as far as competition is concerned, competition has also announced product and announced sale of product. And we don't have enough data as of now to be able to say how well they are doing. But I can tell you about us, we are doing well with the product.